Yeah, don't apologize for that. That was my bad. Okay. We are now recording. So yeah, continuing with problem 7E, like we talked about last week, subsection 84.2 applies in situations where there's been a winding up, discontinuance, or reorganization of the business of the corporation, not the corporation itself. So if you're liquidating the corporation, you've necessarily wound up, dissolved, or reorganized, or sorry, wound up, discontinued, or reorganized the business of the corporation. So subsection 84.2 is going to apply on these facts whether or not the corporation was liquidated. So the answer is it doesn't matter. The result is the same as in problem 7D. And again, the result in the alternative that we posit in 7E, which is what if the cash was distributed on a purchase for cancellation of the shares of BCO. Again, same result as in problem 7D. Again, 84 sub 2 should apply in priority to subsection 84 sub 3. And so you should, again, just be back into the same position as you would be in problem 7D. And even if 84 sub 3 did apply instead of subsection 84 sub 2, again, you're just into the same result in problem 7D where there was a repurchase of shares. So the fact that the corporation may or may not be liquidated, or that this may or may not be the only business of the corporation, both are irrelevant. So that's problem 7E. Everybody still okay? Okay. We can then move on to problem 7F and to slide 20 of our deck. And so in problem 7F, we have individual C who owns 100 of the 1,000 issued and outstanding Class C shares of CECO. C has Puck and ACB of the shares in the shares of 100 each, so $1 each. So Puck and ACB of 100. In 2021, CECO purchased the shares for cancellation. All 1,000 of the outstanding, purchase for cancellation, all of the 1,000 of outstanding Class C shares for $2,000, which means that our individual C, who owns 10%, would have received $200. So that's the first part of, so we can stop there and deal with that first question. So what is the effect of the repurchase here? So in our fact pattern that we've got, there's nothing here about a winding up, discontinuance, or reorganization of C's business. So we can assume that subsection 84.2 does not apply. So on the assumption that CECO is a corporation resident in Canada, then we should be into subsection 84.3, since we've had a repurchase of shares for cancellation by the corporation. So under subsection 84.3, CECO is deemed to have paid a dividend on the Class C shares equal to the amount by which the repurchase price for the shares of $2,000 exceeds the Puck of the repurchase shares of $1,000 immediately prior to the repurchase. We know that the Puck of the repurchase shares here has to be $1,000 in total, because if C owns 100 shares and has Puck and ACB of $100 in total and $1 per share, and we know that Puck averages across the shares of the class, the only way this would be possible is if the Class C shares had Puck of $1,000 in total. So we know that that's the result, is that we have a deemed dividend across all of the Class C shares of $1,000. And so then paragraph 84.3b deems our individual to have received a dividend based on their pro rata ownership of the Class C shares that were repurchased. So again, since our individual C owns 10% of the repurchased shares, then individual C will receive 10% of the dividend, which is $100 in this case. Again, our individual C has disposed of her shares of CCO. And again, because of the application of subsection 84.9, is deemed to have disposed of the shares to the corporation on the repurchase. And so again, we know that there's going to be proceeds of disposition otherwise determined equal to the repurchase price, which was $200. But we also know that paragraph J of the definition of proceeds of disposition in section 54 is going to apply to reduce the proceeds of disposition otherwise determined by the amount of the deemed dividend under subsection 84.3, with the result that there should be only $100 of proceeds of disposition. And since C had ACB of $100 in her shares, then there should be no gain or loss as a result of the disposition. So the only tax consequence of the repurchase is the $100 deemed dividend. So then we can go to the second part of the question. And in the second part of the question, the problem is asking us, well, what happens if the corporation is a publicly traded corporation, the shares of which are listed on the TSX, and CCO effects the purchase by buying outstanding shares through the exchange. So instead of doing whatever corporate step would be required to actually effect a repurchase of the shares that are publicly traded, C just went to a broker and said, here is a pile of money, go buy all the Class C shares that you can through the exchange. So what happens in that fact pattern? And so this is a kind of a different answer, which I don't think we talked about last week. And this is bringing us to have a look at subsection 84 sub 6. And what subsection 84.6 does is it provides that subsection 84.3 is not applicable in respect of an open market share purchase, provided that the shares are acquired by the corporation in the same manner that any member of the public would acquire shares. So in this case, we should presumably satisfy that requirement, since CCO has purchased the shares that it intends to cancel through the exchange, being the way in which any member of the public would acquire the shares. So if subsection 84.6 applies, which it looks like it does, then there's no deemed dividend paid by CCO. Instead, what will happen is that CCO will have paid $2,000 for the Class C shares, and our individual C who sold 10% of the class through the exchange would receive $200 as proceeds of disposition. So then C has an ACB in the shares of $100, and the result is that C realizes a capital gain of $100, being the amount by which the proceeds of disposition of $200 exceed the ACB of $100, 50% inclusion, and so we have a $50 taxable capital gain for C as a result of this transaction. So that is obviously a materially better result for C than might otherwise have been the case. So that's problem 7F. Is everybody okay with problem 7F? Okay. We can then flip to slide 21 and problem 7G, which is our last main section 84 problem. And so in problem 7G, we are assuming in problem 7F that instead of repurchasing the Class C shares for cancellation, the directors of CCO passed a resolution to reduce the stated capital by $2,000. So reducing the stated capital by an amount that's just greater than the amount of money distributed. So that's part one of the problem. So let's start with that. So again, we since we're dealing with problem 7F, we again have nothing to indicate to us on these facts that subsection 84.2 would apply, because there's been no evidence of a winding up, discontinuance, or reorganization of a business of the corporation. And so instead, if we just have a puck reduction of $2,000, then subsection 84.4 should be the relevant provision, and that's what's going to determine our tax consequences. So under paragraph 84.4a, CECO is deemed to have paid a dividend on the Class C shares equal to the amount by which the puck reduction of $2,000 exceeds the puck of the shares immediately before the reduction of $1,000. Again, we know that the puck of the Class C shares had to be $1,000, because if C had puck and ACB of $100 in her Class C shares, and therefore $1 per share. Again, with averaging, we know that the puck had to be $1 per share for the entire class, and therefore $1,000, and therefore $1 per share. So we've got that part, and that's fine. Then paragraph 84.4b will deem the owners of the Class C shares to have received this $1,000 dividend based on their proportionate ownership of the Class C shares. So again, because our individual C owns 10% of the Class C shares of CECO, then C should be deemed to have received a dividend of $100, which is 10% of the total dividend. So again, because we have a puck reduction and we have a distribution of cash in connection with the puck reduction, then subparagraph 53.2a2 should apply and should require our individual C to reduce the ACB of her shares by $100, which was the amount of the puck reduction, and therefore our individual C should have puck and ACB in her shares of nil. Yeah, and that's, I think that's all we need to say about that problem. So that's that. And then we can move to the sort of the second iteration in our problem, which asks how would this change if CECO was a public corporation? And so this does actually change the result. Again, just sort of like problem F, being a public corporation would change the result here as well. And so the reason why this changes is that instead of having subsection 84.4 apply, subsection 84.4.1 applies now. And under subsection 84.4.1, the entire amount of the puck reduction is deemed to be a dividend unless we meet the conditions of subsection 84.4, which generally requires that the public corporation have completed a material non-ordinary course of business transaction within the last 24 months and not have distributed the funds otherwise in connection with that transaction. So we have nothing here that would suggest that those factual requirements have been met. So the result should be that the full $2,000 would be a deemed dividend that would be paid by the public corporation and received by the shareholders. And again, that deemed dividend is in proportion to share ownership. So our individual C should have received a dividend of $100 as a result of subsection 84.4.1 applying. So since the amount of the distribution is entirely deemed to be a dividend, then there would be no reduction of ACB under subparagraph 53.2a2. And so the result is that C gets to keep the ACB in her shares of $100, which isn't necessarily a great trade, but at least it's not nothing. So that's the other part of that result. So that's problem 7G. Is everybody okay so far? Okay. No. Okay. We've got, yes. Can we go over the last part again? Yeah, we absolutely can do that. So I guess we can just go over the last part of problem G. So problem 7G again, the issue here is that if the corporation were a public corporation, then we would be into subsection 84.4.1 rather than subsection 84.4, which applies to returns of capital by public corporations. And what subsection 84.4 does, sorry, 84.4.1 does rather, is it deems the entire amount paid by a public corporation as a return of capital to be a dividend, unless the public corporation has had a material non-ordinary course of business transaction in the last 24 months and has not otherwise distributed the money that it received from that transaction within the last 24 months. So basically the return of capital is a reduction of the proceeds from this non-ordinary course of business transaction. So like I said, we don't have any facts that would allow us to conclude that there has been this non-ordinary course of business transaction. And so we know that subsection 84.4.1 is going to apply. And when subsection 84.4.1 applies, as I said, the entire distribution as a return of capital or otherwise is deemed to be a dividend. And so the result here is going to be that our corporation will be deemed to have paid a dividend of $2,000, which is the amount of the distribution. And the shareholders on the class that receives a distribution are deemed to have received a dividend in proportion to their ownership of the shares of that class. And so our individual C in this case, who owns 10% of the shares of CCO, of the Class C shares, is deemed to have received a dividend of $100, which is is deemed to have received a dividend of $200, which is 10% of the $2,000 distribution in this case. And then the final part of that was just looking at the adjustments to ACB that are required. And in this case, there shouldn't be any, because our individual has our individual has received a dividend of $200. There's no reduction of PUC, and therefore there's no adjustment to the ACB of the shares under subparagraph 53.2A2. So our individual C gets to keep the ACB in her shares, but has received a $200 deemed dividend. Okay, good stuff. All right, anybody else before I move on? Okay, seeing none, let's flip to slide 22. And so slide 22, I'm sure the obvious question is, why do I have a mountain on the slide as opposed to having actual text? This is one of those visual effects that works less well when you're distributing the slides in advance versus when somebody just sees this pop up on the slides in class for the first time. But the answer here is that I borrowed this slide deck concept from Professor Joshua Blank, who's now at UC Irvine, formerly of NYU, who had done the same visual concept, and who had described Section 304 of the Internal Revenue Code in the U.S. as being the mountain of the corporate tax provisions in the Internal Revenue Code that students have to climb in a U.S. corporate tax class. And so Section 304 of the code does the same thing as Section 84.1 of the Income Tax Act. And I think likewise, Section 84.1 is the summit of the mountain that is the corporate tax course in Canada. And because it is mechanically complex, and it does tie together many of the different concepts that we've covered so far in the course. So it is difficult to wrap your head around sometimes. It's also much like summoning a mountain here, because after we're done with section 84.1, the remainder of the stuff we have to talk about in this course is actually a lot easier than this. So you're going to be on the downhill slope of this course after we're done with today's material. So for those of you who have decided that, you know, you hate me, you hate corporate tax, you're never going to do this, you're only here because you got because you got stuck in this course and you didn't drop it fast enough. This is probably the lecture that you have to pay the most attention to of any lecture in this course. As we understand from professional insurers, Section 84.1 problems where people have failed to recognize that it applies and have basically walked their clients into a Section 84.1 trap is the number one tax-related claim under professional liability insurance, number one tax-related claim against non-tax specialists. So, and it's probably a situation where 100% of those people either didn't care enough to cause their clients to get competent tax advice, or because they are, and I think we all know this breed of like 65-year-old lawyer who half-assed their way through a corporate tax course in law school 30 years ago and has completely forgotten all of the substance, but thinks they know what they're doing because, white guy confidence, and just has no idea and has completely walked into a bear trap. So being able to identify situations where Section 84.1 could apply and knowing how to mitigate the potential risks associated with Section 84.1, if you're not going to practice tax, probably the most important thing that you could take away from this course in a very self-interested sense, because it's at least going to prevent you from getting sued. So if we flip to slide 23, we have talked a little bit before in this course about surplus stripping, which is the extraction of corporate retained earnings by a shareholder through a transaction that results in capital gain or capital loss, rather than through the payment of a dividend on the shares owned by the shareholder. Canadian resident shareholders, as we talked about, want to do this because capital gains are taxed at 24% in Alberta in 2021 versus 34.31% for eligible dividends or 42.3% for non-eligible dividends. If you can realize in a transaction where you realize capital gain or capital loss, it also means that shareholders can use the ACB of their shares, or they can use their existing capital losses from other transactions in order to reduce the capital gain that's created in the surplus strip transaction. And there's really no equivalent to to that when you have a dividend. If you had a non-capital loss, you could potentially reduce the dividend income if you just paid a dividend, but individuals tend not to have personal non-capital losses, so that's not usually a feasible option. Non-resident shareholders, would love to be able to do surplus strip transactions if they could, because, unlike deemed dividends, which are subject to Canadian withholding tax, capital gains generally are not subject to any kind of Canadian tax if the shares are not taxable Canadian property. So you would have potentially no Canadian tax at all. If you are non-resident, you can do a surplus strip. So this is what Section 84.1 is here to prevent. Section 84.1 is the anti-surplus stripping provision that applies to Canadian resident shareholders. There is an equivalent for non-resident shareholders, which is Section 212.1. Which you're either covering right now in international tax or will never cover international tax because that course has ceased to exist. But either way, know that Section 212.1 is there and that it's actually more stringent than Section 84.1. Section 84.1 is relatively chill by comparison to to section 212.1. So we can flip to slide 24. And, beyond that last little bit of talking, I did try to think about how I could explain section 84.1, and I've thought about this every year. How you're able to explain what section 84 is intended to combat. And, I think it's really hard to do that without giving you an example of where section 84 is intended to apply and how it applies when it does. So if we can go to problem 2 in handout number 18 and we work through this problem, we'll probably have a better feel for what section 84.1 is supposed to do. So in our problem, our individual A is the sole shareholder of ACO. A owns 100 Class A shares of ACO with PUC and ACB of $100 and a fair market value of $500. So we know we have an accrued gain in our shares of $500, and we have a gap of $400 between the fair market value of the shares and the PUC of the shares. So what we're going to see is that our individual B thinks that they have a way to get clever and to avoid having to pay tax on a dividend if they wanted to pull $500 out of the corporation, since there would otherwise, even if you reduce the PUC of the shares, be a $400 dividend. So individual A incorporates BCO and transfers to BCO the Class A shares of ACO in return for Class B shares of BCO. So we have a share-for-share exchange. However, the stated capital, and therefore the PUC, of the Class B shares of BCO has been increased to $500, which is the fair market value of the Class A shares. And recall that under the ABCA, that would be permissible, right? If it wasn't for the tax reasons, people would do this kind of stuff where you would add $500 to the stated capital of the Class B shares of BCO, because that's the fair market value of the property that was transferred to the corporation in consideration for the Class B shares. So that would be permissible under corporate law. Then immediately after the transfer of the ACO shares, ACO pays a dividend to BCO. And so it's a $500 dividend. And again, because ACO and BCO are both taxable Canadian corporations, BCO would get to deduct that dividend under subsection 112.1 when it's received. And they're connected. They're both one, in this case, Corporation B controls Corporation A directly. So they're clearly connected. And therefore, we wouldn't have any Part 4 tax on the intercorporate dividend so long as our Corporation A doesn't receive a dividend refund as a result of this dividend, which let's assume that they don't. So then the dividend is distributed to A on the redemption of the Class B shares of BCO. So again, if we just took the facts as they're stipulated, then we'd say, okay, the Class B shares of BCO had PUC and ACB of the Class B shares had PUC and ACB of $500. And so as a result, the repurchase under subsection 84.3 or otherwise would not result in the deemed dividend, because there'd be PUC equal to ACB, so there's no gap between the two. And so that's it. We would have proceeds of disposition, otherwise determined, of $500. There'd be no reduction, because paragraph J of the definition of proceeds of disposition would just be zero because there's no deemed dividend. But B has ACB of $500 in the Class B shares of BCO. And so no gain or loss is realized there either. So the entire result then, if section 84.1 didn't apply, would be that individual B would have realized a $400 capital gain on the transfer of the Class A shares of BCO, the Class A shares of ACO to BCO at the commencement of the series of transactions. And we would have had a 50% inclusion for that capital gain. So we would have net a $200 taxable capital gain. And so we would then just had 48% tax on the $200 taxable capital gain, which is 24% of the total $400 capital gain, and that would be it. So it would have been, and that's that's the entire result, and that's what we're trying to prevent. Is basically that situation where there's no arm's length money coming in, but just by selling shares from one corporation to another, you've reduced the tax from the dividend rate, which in this case probably would have been 42.3%, down to 24%. And it could get worse, because if the shares were QSBC shares, then what could have happened would have been, what could have happened would have been that our individual would have just paid no tax whatsoever on the capital gain, because they would have claimed their capital gains deduction. So the problem then asks, again, in the absence of section 84.1, what would happen if instead of the last transaction, where it was a share for share exchange, where individual A took back Class B shares of BCO with HIPOC and repurchased them, what if our individual B took back a promissory note from BCO? And here the result is the same, right? Everything happens the same. So individual A sells the Class A shares of ACO to BCO in exchange for the note, realizes the $400 capital gain. ACO pays the dividend to BCO, again, still connected, still no Part 4 tax, still a subsection 112(1) deduction. So Corporation B has no tax, and then Corporation B repays the note. Again, since our individual A had cost in the note equal to the principal amount of the note, no gain or loss on the repayment of the note, and therefore no tax consequences. So the result is that we get to the same result by a slightly different mechanic, but again, the only tax consequence in this fact pattern is that our individual A realized a $400 capital gain instead of a $400 dividend. So that's what we are trying to prevent. So everybody okay there? Yes, Leah.
I just want to double check that so does A incorporating BCO, wait a second, sorry.
No worries.
When they transfer the shares initially, that is when the capital gain occurs, is that correct?
That's okay. Right, yeah. So in both fact patterns, and as we're going to see starting next week, there are ways you can do share for share exchanges on a tax deferred basis, where you could have exchanged A shares of ACO for shares of BCO on a tax deferred basis, but we're assuming they're not doing that here. And certainly with a note, you wouldn't get a deferral. So when ACO sells the shares of, when A sells the shares of ACO to BCO, we're assuming in this example where there's no such thing as 84.1 that individual A would be realizing a capital gain on that transaction.
Okay, I think that makes sense. Thank you.
Yeah, no problem. Okay, anybody else? Okay, seeing nobody else, let's pause here. This is a good moment for a break, and then we can dive into sort of the technical aspects of section 84.1 when we come back.